Did you know we finance everything we buy? My name is Carmen and this is Darius, and we are the founders of Wealth Nation.
When it comes to financing our purchases, there's two different ways that traditionally we finance everything, and that's either we go in debt for it or we save for it. So when it comes to debt or credit, let's say we want to purchase, for example, we want to purchase a brand new computer. That computer, we don't necessarily have the funds in cash available to purchase it outright. So let's say it's a Mac, we'll go to Apple and say, okay, put me on a payment plan, a monthly payment plan to finance this computer. What you'll do is you'll make payments every single month, and what they'll do is they'll tack on some interest to it, because that's just how we do things. If we don't have enough money in our account, there's no shortage of places that we can get money to finance it, because they want us to pay them back principal and interest. So by the time we own this computer, let's say it's a 12-month term, we would have paid them back principal and interest. Now, the second way we finance things is through saving. Right?
And how we do that is we save up the money. So that same computer, as opposed to paying the bank every single month principal and interest, we're putting that money away or paying ourselves every single month in our savings account so that we can afford the computer and pay it cash. So when Darius spoke, it's really interesting to think about the fact that you can either finance it through the bank or you can finance through yourself. And that's why we talk about you finance everything you buy, because you're either paying it through someone else's funds or you're paying it through your funds. So I'm going to flip on the computer so that you can see exactly what we're talking about from a visual standpoint. As we talked about earlier, you finance everything you buy, whether you go into debt to buy a purchase or you save up the money. So right here, I'm actually going to break it down so you can see what everything looks like. First, we're going to start with a debtor. A debtor is somebody who has no savings. They earn no interest because they're paying out money. They're paying out interest to financial institutions. So the definition of a debtor is they borrow from the lender at high market rates and they use their future earning potential as collateral. Now, for those debtors out there, how many of you have been asked, what is your current earning potential? What is your future earning potential? They ask you these questions because the banks want to make sure that you can pay them back. So this is what the debtor looks like. We start at zero, but then we go into the negative. And then we build our way back up month after month on those minimum payments to get back to zero. And what happens? We do it again and again and again. So this first quadrant may just be the computer that we talked about, followed by a car, followed by some more credit card debt. Whatever the case may be, we end up in the vicious cycle of the debtor and having to pay principal and interest to someone else. Now, on the contrary, we have the saver. The saver is somebody who saves money, they earn interest, and they pay cash for everything. So the saver is someone we consider the individual who considers cash as king. Now, the saver is somebody who borrows from themselves and they reduce their current collateral position. So what do we mean by that? If you have a savings account with money that you've been saving over time or you've been financing by making payments into your savings account, when you reduce that savings principal, you have affected the collateral positioning that you can obtain. Meaning if you wanting to get more money or if you wanted to obtain more assets, you now no longer have collateral to utilize because that money is gone. And in addition to reducing your collateral position, now you have to reset compounding because that money is no longer there. So you have to start that interest earning potential all over again. So what does a saver look like? As you see here on the screen, we start at zero and then we build our way up. until we get to a situation where we want to make a purchase. It's time to make a purchase, and then what happens? We drain our savings account and do it again and again and again. So instead of now financing purchases through a financial institution, we are now financing it from ourselves by putting that money away in our savings account. Have you ever thought what it looks like when we compare the debtor and the saver together? Well, take a look. Because we say stop the insanity. When you put the debtor and the saver together, they're actually mirror images of each other. And if you notice, the saver and the debtor both end up at zero. So whether you have to go into the negative and build your way back up to zero, or you build your way up and then make a purchase and start over at zero, you still end up at zero. So is the debtor or the saver in a better position? I love sharing this information because we really want to make sure that when you are trying to level up your financial game, you understand all of this information and how it affects you. Because at the end of the day, what Darius and I want to show you is how to most efficiently use your money. And if the debtor and the saver both end up at zero, who is in the better position? Maybe there's another way for us to utilize our money.
So what Karma just shared with us is the fact that we finance everything, whether we know it or not. We either are a debtor, which means that we're buying something on credit, or we're a saver, which means we're saving up for it and paying cash. We need to start rethinking how we finance the things that we want in life or the things that we need in life. We need to start taking more control of it so that we can redirect those funds back to ourselves so that we can utilize it over and over again. That's why we call it infinite banking. It's infinite. You just continuously use the same money over and over again. So as you move forward with this information that we shared with you, start thinking of the stuff that you're doing within your lifestyle now and how you can utilize infinite banking to start making money from it. Because infinite banking gives you the ability to earn money or create cash flow off of anything. Once we go from there, you move into your investing. And there's a plethora of opportunities that you can create just for yourself.
So true. And the other thing to keep in mind is that you either are paying interest to someone else by financing that computer through them, or you're losing your ability to earn interest when you self-finance to put those things together. So you either lose interest, or you either pay out interest, or you lose your ability to earn interest. So if you like the information that we're sharing with you, be sure to subscribe to our YouTube page and like this video. Also, check out our website at wealthnation.io, where you can register for free for our Infinite Banking 101 webinar and our Move Money to Make Money webinar. And also follow us on Facebook and Instagram at wealthnation.io. Have a great day.